Ever wondered how much return you are really getting for the risk you take in the market? That's exactly what the Treynor Ratio reveals. It measures how efficiently your portfolio earns returns for every unit of market risk, helping you see whether your performance truly justifies your exposure. Before we dive in, a quick note: this video is for educational purposes only. Always consult a financial advisor before investing. Alright, let's get started. There are two types of risk: systematic and unsystematic. Systematic risk comes from the market itself. You can't diversify it away. The Treynor Ratio focuses only on that part. It shows how efficiently your portfolio converts market risk into returns. Here's the simple definition. The Treynor Ratio equals your portfolio return minus the risk-free rate, divided by your portfolio's beta. It was developed by Jack Treynor to evaluate fund performance based purely on market risk exposure. Let's break that down. Portfolio return, that's your actual or expected gain. Risk-free rate, think of it like what you'd get from a government bond. And beta, it measures how sensitive your portfolio is to market movements. A beta of 1 means your portfolio moves in line with the market. Greater than 1 means it's more volatile. Let's put some numbers to it. Say your portfolio returned 12%, the risk-free rate is 4%, and your beta is 1.5. Subtract 4 from 12, and divide that 8% by 1.5. You get 5.33, that's your Treynor Ratio. In simple terms, you earned 5.33% of extra return for every unit of market risk you took on. The higher the Treynor Ratio, the better your risk-adjusted performance. So, how do you read it? Higher Treynor Ratios mean the fund manager is doing a good job of generating returns for each unit of market risk. If it's low or negative, it means the returns didn't justify the exposure. When comparing mutual funds, the one with a higher Treynor Ratio is typically managing market risk more efficiently. The Treynor Ratio works best when your portfolio is well diversified, because it assumes that all unsystematic risks are already minimized. It's ideal for analyzing professional fund managers or large diversified funds where market risk is the main driver. Now, let's compare it with the Sharpe ratio. They look similar but measure different things. The Sharpe ratio considers total risk, including both market and specific company risk. The Treynor Ratio only looks at systematic market risk, using beta. So, if your portfolio is already diversified, Treynor gives you a cleaner picture. Of course, no ratio is perfect. The Treynor Ratio depends heavily on beta. If your beta isn't accurate, your results can be misleading. It's also less useful for portfolios that aren't diversified, and like most metrics, it's based on historical data. It doesn't predict the future. Here are some quick tips. Don't use the Treynor Ratio in isolation. Pair it with Sharpe, Alpha, or the information ratio for a full view. Always compare funds using the same benchmark and time period. And remember, it's better for spotting performance trends over time rather than relying on a single snapshot. In India, analysts often use the Treynor Ratio to compare equity and hybrid mutual funds. It's especially useful for large-cap diversified funds where market exposure is the main source of risk. Typically, beta is measured against broad market indices like the Nifty 50 or the Sensex. The higher the ratio, the more efficiently the fund is handling that market volatility. The Treynor Ratio measures how much excess return you earn per unit of market risk. It's most effective when used on diversified portfolios. Remember, higher is better, but always in context with similar funds and timeframes. It's one of those rare metrics that tells you not just how much you made, but how smartly you took the risk to get there. Thanks for watching. Check out the description for extra resources and related videos. And if you found this video helpful, give it a thumbs up and share it with someone who's trying to make smarter investment decisions. And don't forget to subscribe to Secure My Wish, where we simplify finance, one concept at a time.